Right now we have historic low interest rates, but what does that really mean related to how much home you can actually buy? Hi, welcome back to this episode of Real Life at Level 10. My name's Matt Farnham. This is a show where we discuss insights of real estate, leadership, and personal growth. This episode, I want to talk about these historically low interest rates and what does that really mean as far as how much home you can afford versus how home pricing going up or down relates to these rates as well. A question that we get all the time is, well, I know the market's been hot for quite a while. Should we wait to purchase, wait for prices to come down? And listen, that might happen next month, that might happen 10 years from now. Nobody has a crystal ball for sure, but you could be waiting a long time. But let's talk about what these interest rates really mean when it comes to affordability. Right now, affordability is at an all-time high, and that's because of these rates. Right now, we're seeing buyers lock 30-year loans under 3% for conventional FHA, VA financing. It's absolutely incredible. So I am not saying before I get into this that the home price doesn't matter. The home price absolutely matters. When you sell that home again one day, whether that's 3 years, 5 years, 20 years down the road, what you purchased it for is obviously going to impact how much equity and proceeds you end up having in the home. What I just want to explain to you is shed light on how big of a impact the rate makes to your monthly budget and your payment. Fact of the matter is, price is important, but what we see is most families are really building their life around a monthly budget, and that payment is a major factor on what home they decide to purchase. All right, so before I get into some real hard number examples for you, I do want to share with you a blog that I follow, Keeping Current Matters. KCM blog does a great job of educating realtors, buyers, and sellers on what's happening in the national market, but they actually just released a study that they did where 2 years ago compared to today, the average American can afford $32,000 more home today than just 2 years ago. And that speaks to just how powerful these historically low interest rates are affecting affordability. And keep in mind, 2 years ago, interest rates were low 2 years ago, but right now they're just insanely low. So now let me give you some real hard numbers. I've actually jotted down some examples here to share with you. And I'm going to share two price points that are very common in the Las Vegas market where I'm at. And that's a $300,000 example as well as a $500,000 example. So let me give you some real numbers to just paint a picture for you on how this impacts affordability. So in a $300,000 home, and for all these examples, we're going to do a 10% down payment on a 30-year fixed loan. All right, so $300,000 at a 3% interest rate. The principal and interest portion of your loan, of your payment, is going to be $1,138. $300,000, 3% interest rate, principal and interest payment, $1,138. Now let's say that you say, well, I'm going to wait a year or two for home prices to come down. Let's say home prices do come down. And that's a very hypothetical, but let's say they come down 5%. So let's say you buy a year or two from now and prices drop 5%, that same $300,000 home is now $285,000. Let's say in the same 1 or 2 year period, interest rates climbed up to 3.5%. They went up 50 basis points or 0.5%. So in that same example, $285,000, 10% down, 30-year fixed at a 3.5% interest rate, the P&I, principal and interest portion of your payment, will be $1,151 per month. That is $13 more per month than the same home at a $300,000 price point at the 3% interest rate. So you can see how the big impact that interest rate can have on the payment. So now let's take this up to a $500,000 example and unpack that for you. So we have a $500,000 home, 10% down payment, 30-year fixed loan at a 3% interest rate. In that example, the principal and interest will be $1,897 per month. Same example, let's say home prices did drop in value 5% in a year or two or three or whatever that is, but interest rates went up that same 0.5%. So now we have a $475,000 home at a 3.5% interest rate. The P&I portion of the payment is $1,919. So that's actually $22 higher than the first example. And then let's be a little bit more dramatic and say home prices fell 10% because you waited a year or two or three. So that $500,000 home is now $450,000. But let's say in the same time period, interest rates went up 1%. A lot of people expect that in the years to come that we will see inflation, we will see rates start to climb. They can't stay historically low forever. So this is a fair conversation that we're having here. But $450,000 home at a 4% interest rate, still incredibly low rate, would bring the P&I portion of your payment to $1,933. So again, up a little bit higher from that previous example. So again, you can see how powerful this rate is when it comes to your payment. And in summary, what you can kind of tell as a summary here is that if home prices were to drop 5% and rates go up 0.5 point, it's going to pretty much balance out as far as your monthly payment is concerned. If home prices change 10% and rates change 1%, same thing, it's going to balance about equal on that. Now, I know what some of you are thinking watching this. Well, Matt, what happens if home prices go up and interest rates go up? So let me just give you one more example using that same $500,000 price point. If the home price went up 5% over the next year and the interest rate went up 0.5% or 50 basis points in the next year, that example, the P&I portion of the payment would be $2,121. So that is $224 more per month than the same home in the first example of $500,000 at a 3% interest rate. So again, major factor in the affordability of how much home you can purchase. So I do want to clarify one thing. The price of the home is very important. You have to be a very wise steward when you're buying a home. Make sure you're not overpaying for a property. There are realtors out there that will say, hey, if you offer $3,000 more or $5,000 more, it only increases your payment $18 a month or $25 a month. And that might be true, but that's a slippery slope when you start playing that game and you start overpaying for property, which you do not want to do. So could home prices fall in a year or two or three? Of course they could. Could they keep going up? Absolutely. And yes, if home prices fell and you time that market perfectly, you might feel like a hero. But the reverse argument is if you're renting for that 2 or 3 years while you wait, you're also paying down somebody else's mortgage. Instead of paying down the mortgage, you could be paying down on your own, which would minimize some of that reduction that you waited for. So a lot of things to consider. This is why you need some professional guidance and advice on if buying right now is right for you or not. But I just wanted to unpack the affordability factor of how big that rate actually impacts your payment. So I'll leave you with this. There's an old saying in real estate that says, you do not wait to buy real estate, you buy real estate and wait. So we tell our clients, look, we make the best decisions we can with the information we have today. And if with the low interest rates today, you feel comfortable purchasing now, buy and get a great professional to guide you through that process. If you think home prices could fall and that rate's not important to you, then wait. There is no right answer. It's what's right for you. And in all fairness, one thing a friend of mine, a financial advisor, has told me in the past is the rate only matters if you own the home for 20 or 30 years, when a lot of people don't. You might own a home for 5 or 7 or 8 years. So the home price is a major factor, of course, but I just wanted to help you understand what it actually means for your payment, rate versus price, and all those things. So I hope you found value in this. Please share this content if you know anybody else that is crunching numbers right now and trying to understand all of this. And for many of you, I know that you are watching this, I'm getting the feedback, but you have not subscribed yet. It would be a huge favor to me personally and our team if you would subscribe to this content on YouTube, on the podcast as well. We love getting your questions as well, so it helps us provide a better content that's applicable to you and interesting to you. So again, thanks for watching this episode of Real Life at Level 10. Whatever it is you're doing or walking through, do it at a level 10 and live with the results. This episode was filmed at our Team Farnham listing at 2816 Josephine in the guard gates of Club Madera in Henderson. For more information on this home or any of our Team Farnham listings, visit teamfarnham.com.